and let's particularly focus around the white maize, yellow maize and wheat markets, because obviously there's a lot of staple food being white maize, and wheat is impacting bread and everything else that goes with it. So if you look at the trend in there, and if we had to look at the wheat contract, the December 10, so that is the futures contract that expires next month, and you look at that upward trend. Now there's been a lot of movement over the last year on that wheat contract. If you go and see the all-time low was just above 2,100 Rand a ton. And really a lot of wheat farmers were pleading for some kind of protection with the government, and there was a wheat tariff introduced for imported wheat coming into South Africa. South Africa is a net importer of wheat, and when that news broke, you could see the market doing that first big jump of just over around 200 Rand. But the real big jump in around August was a result of the Russian wheat crisis.
Yeah.
Where
of course, there with drought persisting and Russia then imposing trade restrictions on its exports.
Definitely. So that had a huge impact, because look, at the end of the day, although we're producing maize and wheat in South Africa, we're also governed by international supply and demand factors. So that had a huge impact on the local wheat price, as you can see by that chart. So really we've peaked around the 2,800 Rand level. And since then we have fallen off. Yesterday was a big fall off day where we ended just below the 2,600 Rand mark. So again, if you look at that chart, there's been opportunities for both sides of the industry to use price risk management instrument, the futures contract, to manage their price risk. So as a farmer, you could have locked in as high as 2,800 Rand. And as a miller, you could have said, well, you could have bought stock at around 2,300 quite comfortably.
But you've got to have an understanding of all the kind of dynamics at play right now. So let's take a look at that and the kind of demand-supply dynamic that could possibly be influencing price movement from here on out.
Again, that dynamic is, we're reliant on rainfall, and for a farmer, they're looking at prices where they can produce and still market their goods at a profit. I think trying to find that balance. If you look at the wheat industry, yes, there's been a decline in the amount of wheat produced, and that was really on the back of those early price signals just weren't high enough for farmers to put wheat into the ground. However, if you look at the maize charts, and let's say you had a look at the July 2011 maize chart. So let's move through and say farmers at this point in time in South Africa are sowing their crop into the soil, and they need to make a decision: are they going to plant maize, soybean, sunflower seed? Those are the dynamics, and really the futures market is trying to give you that price indicator. So for next year, you can see yellow maize is still trading above white maize, which is an interesting anomaly. We can get that maybe if we've got some time a bit later. And there's really a 40 Rand premium that goes with yellow maize trading at the moment. So you still, if you wanted to lock in a price for next year, around the 13.30, 13.40 for white maize. Now, farmers can use this mechanism to lock in should prices fall, if there's another surplus produced, if we get good rainfall. So it's all about trying to manage price risk. But if you look at the international supply situation, and you look at the USDA, United States Department of Agri, releases reports, and really we do see a downward trend in supply, international supply, which will filter through. But again, South Africa also has its own unique demand and supply situation, and if we have another good season, we produced just under 13 million tons this year. So there's a dynamic that is focusing around South Africa, plus then impacted by the international markets.
Of course, a dynamic that's focused on sub-Saharan Africa as a region as well. I mean, if we take a look at Zambia, for example, producing a surplus maize for the export market, so there's rising production levels happening on the continent itself right now.
Yeah, it's really exciting to see as other markets are desperately looking for product, that the Southern African with Zambia, there's also a lot of optimism in Zimbabwe to also increase their production. So yeah, it's all positive from the grain production side. It's really how do you maintain for a farmer out there to continue producing and still lock in profits, and that's where futures and option instruments, derivatives, should be considered for that.
Let's take a look at the South African debate that's raging now, because there's a debate around genetically modified versus non-GM products. because of our involvement within the GM space specifically, what impact is that having on our supply and our export capability?
Yeah, I think because, you know, the grain market in South Africa is one of the freest in the world. So it goes down to let's be as efficient and let's try and produce the maximum and gain the maximum yields, where we've seen farmers moving to the genetically modified cultivars. This unfortunately shoots us in the foot when we're trying to supply our northern neighbours, because a number of them still only accept non-GM product. So yes, it is hampering South Africa's export markets, where we need to then look further afield other than the African continent.
We've been hearing over the recent past for the need, despite that and despite that kind of limitation that the South African export market faces right now, the need for a pool, an export pool to export South African surpluses that would put producers in a more favourable position. What's your view on that? Is that really necessary?
Being a free marketeer, I think if you look at the fundamentals and what it enables the market to operate in the most efficient way is the least amount of intervention. And if you look at perhaps maybe there's smarter ways of doing it. Instead of having an export pool, perhaps rather look at improving the infrastructure of moving product out of South Africa. So look at your rail networks, look at your harbour facilities. If there's a lot of efficiency to move product out of the country, then there's no need for an export pool to be managed by a certain group. Rather, let the traders, who are their core business is moving grain around the world, let them benefit by the efficiencies of moving product out, and then let the natural market forces